For over a century, every major financial crisis, every market crash, every liquidity panic, every unexpected collapse ends the same way. Small banks disappear, middle-class wealth evaporates, governments scramble, and the same global institutions emerge stronger than before. Look closely, and you'll see the same fingerprints on 1907, 1929, 1987, 2008, 2020, and 2023. Different eras, different technologies. Same pattern. Crises don't just happen. They're shaped, guided, and in the most critical moments, controlled. And the ones doing the controlling? A network of financial institutions so interconnected, so deeply embedded inside governments and central banks, that most people will never know how much influence they hold. This is the story of that network. The banking cartel that never loses a crisis. Understanding this matters, because in every crisis, someone pays. In 1929, Americans lost 89% of their stock market wealth. In 2008, families lost $19 trillion in home equity. In 2020, inflation wiped out 30% of the value of savings. But the large banks? They expanded, merged, consolidated, and positioned themselves for the next cycle. The stakes here are not just financial. They're structural. If history continues the same pattern, the next crisis won't simply be another recession. It will be a transfer of power from nations to global financial institutions. A small network of banks, linked through ownership, credit lines, and coordinating institutions like the Federal Reserve and the BIS, has repeatedly shaped, directed, and profited from financial collapses for more than 150 years. This isn't conspiracy. It's design. Crises don't weaken the system. They strengthen the institutions that sit at its center. Because the system is built for them, not for us. Here's the path we'll follow. Chapter 1. How the first global banking networks formed, from Morgan to the Federal Reserve to the BS. Chapter 2. 3 major crises where the same institutions reappeared: 1929, the S&L crisis, and 2008. Chapter 3. The Cartel Playbook, the 4-stage cycle that repeats in every collapse. Present day. How the same structure exists right now, larger, more interconnected, and more powerful. Synthesis. Why the next crisis will follow the same pattern, but faster. Final warning. What this means for your savings, your bank, and your financial future. Before we begin, here's the piece almost no one knows. In 2011, a group of economists from the Swiss Federal Institute of Technology analyzed 43,000 multinational corporations. After mapping ownership networks, they discovered something astonishing. 147 companies controlled 40% of global corporate wealth. And within those 147, the core was dominated not by tech companies, not by manufacturing giants, but by financial institutions. J.P. Morgan, Goldman Sachs, Citigroup, UBS, Barclays, Deutsche Bank, Credit Suisse, Bank of America, State Street, Vanguard, BlackRock. That was over a decade ago. Today, that concentration is even stronger. Chapter 1. The birth of the banking cartel. To understand how a small group of banks came to influence global crises, we need to go back to where the pattern began. Case Study 1. The House of Morgan, the late 1800s, 1913. The rise of modern banking power begins with a name that still echoes today. Morgan. In the late 1800s, the U.S. government was drowning in debt and losing gold reserves. Confidence in the dollar was collapsing. And when a nation needed help, J.P. Morgan stepped in, not as a patriot, but as a creditor. Key events. 1895. Morgan forms a syndicate that loans gold to the U.S. Treasury, preventing default. This gives Morgan unprecedented leverage over national policy. Morgan partners are given advisory power inside the Treasury. Early example of private bankers directing public financial decisions. Morgan consolidates railroads, controlling roughly 1/3 of U.S. rail traffic. Transport, trade, and credit begin to merge. 1907 panic. When financial markets crashed, it wasn't the government that decided which banks lived and died. It was Morgan. He summoned bank presidents to his library, locked the doors, and dictated the rescue terms, forcing smaller banks to merge into larger ones. Some historians call him the unofficial central bank. But his power exposed a deeper truth. A private financier should never have this much control, which leads to the next stage of the pattern. Case Study 2. The founding of the Federal Reserve, 1910 to 1913. The Panic of 1907 showed the U.S. that Morgan had too much influence. But instead of reducing it, the solution strengthened the model. In 1910, a secret meeting was held at Jekyll Island, a private club owned by J.P. Morgan's associates. Attendees included Nelson Aldrich, Senator; Paul Warburg, Kuhn Loeb Bank; Frank Vanderlip, National City Bank; Henry Davison, Morgan partner. Over 9 days, they drafted the blueprint for a new central banking system, a system that would centralize the supply of money, centralize credit, centralize emergency liquidity, and ultimately centralize power. In 1913, the Federal Reserve Act was signed. Most Americans believe the Fed is a government institution, but the truth is more complicated. The Fed is a hybrid system. Its regional banks are owned by private member banks. Those banks elect the directors who influence Federal Reserve policy. The architecture of the modern banking cartel was now in place. But something bigger was coming. The world's first global bank. Case Study 3, BIS. Formation, 1930. The next part will cover the creation of the BIS. Chapter 1. The birth of the banking cartel, continued. Case Study 3, the Bank for International Settlements, BIS. 1930. If the Federal Reserve centralized American finance, the BIS centralized global finance. In 1930, central bankers from the U.S., Britain, France, Germany, Belgium, and Italy formed the Bank for International Settlements, the world's first supranational financial institution. Officially, it was created to manage German reparations after World War I. Unofficially, it was designed to give central banks a private, politically immune forum to coordinate global monetary policy. Key events and powers, BIS was granted. Legal immunity, tax exemption, diplomatic protections, secrecy privileges, operational autonomy. It sits above national law, a bank that no government can regulate. Its board has historically included members from the world's most powerful central banks. Decisions made inside BIS meetings determine global interest rates, liquidity flows, cross-border settlements, banking regulations. And yet, most people have never heard of it. The BIS became the nerve center of the new financial architecture, a place where global bankers could coordinate crises, share information, and guide policy without political interference. By the mid-20th century, the structure of the modern banking cartel was complete. But the world would soon discover what that structure truly meant when the first major crisis hit. Chapter 2. Crises where the cartel reappeared. Every crisis in modern history reveals the same pattern. Leverage rises, liquidity dries up, panic spreads, small institutions fall, big banks consolidate. Let's walk through 3 major economic collapses where the banking cartel's influence was undeniable. Case Study 1. The Great Depression, 1929 to 1933. The Roaring '20s were fueled by leverage. Margin loans allowed investors to buy stocks with only 10% down. Banks issued speculative credit freely. Asset prices soared far above real value. And the institutions enabling this speculative frenzy? The same large banks tied to the Federal Reserve System. Key events. 1929. Leverage reached unsustainable levels. When stocks turned downward, forced liquidations accelerated the crash. October 29, 1929. Black Tuesday. Panic selling wiped out billions in paper wealth. Margin calls cascaded. Small banks collapsed under withdrawals. 1930 to 1932. More than 9,000 banks failed across the U.S. Families lost their savings overnight. Meanwhile, large banks with access to Federal Reserve liquidity used the crisis to buy distressed assets for pennies. The cartel advantage. 1. Insider credit lines. Big banks received emergency lending. Small banks did not. 2. Preferential access. When liquidity dried up, the Fed supported institutions it considered systemically important. 3. Post-crash consolidation. Major banks gained even more control over deposits, lending, and markets. The public lost everything, the major banks grew. A pattern that would repeat again. Case Study 2. The Savings and Loan Crisis, 1980 to 1990. The S&L crisis is rarely discussed today, but it was one of the largest financial failures in American history and one of the clearest examples of engineered consolidation. Savings and loans, S&LS, were small regional institutions. For decades, they served local communities and families. But in the 1980s, Deregulation changed everything. Key events. SNLS gained new powers: commercial lending, speculative investments, and real estate development. Many lacked experience in these areas. Corruption and mismanagement spread. High interest rates crushed their balance sheets. By the mid-1980s, hundreds of SNLS were insolvent. Who benefited? Large Wall Street banks. Here's how. 1. Deregulation pushed smaller institutions into risky areas. 2. When failures began, the government stepped in with an eventual bailout cost of $132 billion. 3. Large banks bought failed SNLS assets at massive discounts. The public paid the bill. The big banks walked away with the savings. It was a controlled burn, a weakening of the decentralized banking system and the rise of the megabanks we know today. Case Study 3. The Global Financial Crisis, 2008. This is the crisis most people remember, but few understand how deeply the pattern was embedded. The setup. Large banks created mortgage-backed securities, MBS, and collateralized debt obligations, CDOs. Rating agencies, paid by the same banks, labeled them AAA. Derivatives like credit default swaps magnified risk. The entire system sat on a foundation of bad loans, complex products, extreme leverage, false ratings. When the housing bubble burst, the structure collapsed. Key events. Lehman Brothers fails, panic spreads globally. AIG collapses, rescued to pay counterparties, large banks. TARP bailout. $700 billion majority flowed to the largest institutions. Federal Reserve programs inject over $16 trillion in liquidity, audited later. Most benefiting the same network of global banks. Who lost? Homeowners, small banks, pension funds, workers, retirees. Who won? JP Morgan, Bank of America, Wells Fargo, Goldman Sachs, Morgan Stanley, BlackRock. Through mergers and bailouts, the crisis reduced competition and increased concentration. By 2010, 5 banks controlled nearly half of all U.S. deposits. The public experienced the worst recession since 1930. The banking cartel experienced its greatest consolidation in modern history. Transition to Chapter 3. We've now seen 3 major collapses, different decades, different triggers, different governments, but the same outcome. Crisis, consolidation, control. This is not coincidence. It is a cycle. And in the next chapter, we break down the exact playbook used by the banking cartel in every financial collapse. Chapter 3. The Cartel Playbook. How the system really works. Now that we've examined 3 major crises, let's zoom out and look at the structure behind them. Because what looks like chaos from the outside follows a predictable pattern on the inside. Every financial collapse, whether in 1929, 1987, 2008, or 2020, runs through the same 4 stages. This is the cartel playbook. Stage 1. Expansion. This is the phase most people enjoy. Markets rise. Credit expands. Debt becomes cheap. Optimism spreads. But behind the scenes, the cartel sets the tone. How it works. Central banks lower interest rates. Large banks expand lending aggressively. Asset prices inflate. Stocks, real estate, commodities. Ordinary people feel wealthier, even if it's all debt-driven. Financial institutions earn massive profits from underwriting, lending, and speculation. During this stage, regulators tend to trust the market. Warnings are ignored, and risk piles up invisibly. It's not an accident, it's preparation. Stage 2. Stress. This is the moment where insiders notice what the public can't see. Liquidity tightens. Defaults rise in small pockets. Derivatives spike. Interbank lending slows. Banks quietly begin repositioning. But the public? Still optimistic. What happens in stress phase? Banks reduce exposure to risky assets. They increase collateral demands. Short selling volumes rise. Rating agencies issue early warnings. Hedge funds start buying insurance against collapse. This is the phase where signals appear, but only those inside the financial system fully see them. Everyone else is still asleep. Stage 3. Controlled collapse. This is where the system breaks, but not in the way most people think. Collapses do not hit everyone equally. Small banks fail first. Small lenders disappear. Small businesses lose credit. Small investors panic. But large banks? They enter the collapse with access to emergency lending, direct Federal Reserve support, special liquidity windows, repo facilities, Coordinated central bank interventions. While the public is losing savings, the cartel is buying assets cheaply and absorbing competitors. Controlled collapse looks like sudden liquidity stops, sharp price declines, surprise, insolvencies, government interventions, forced mergers, bailouts, emergency regulations. At the end of this stage, the financial system becomes more concentrated, and the cartel becomes more powerful. Stage 4. Reconstruction. After the chaos, the narrative shifts. We need stronger regulations. We need bigger institutions. We need to protect the system. These talking points always lead to the same outcome: new rules that favor the largest banks. Reconstruction phase includes new capital requirements, new liquidity standards, restrictions that smaller banks cannot meet, mergers encouraged for stability, central banks gaining more authority, government dependency on large financial institutions. The crisis is framed as a failure of free markets, but in reality, it was a reset that benefits the same institutions every time. The cycle resets. Expansion, stress, controlled collapse, reconstruction. Then it begins again. The key lesson? Crises are not interruptions of the system. Crises are functions of the system, and the institutions at the center always emerge stronger. 7. Present-day application, the cartel today. Now we bring it to the modern world. Because the system you live under today is the most interconnected, concentrated, and powerful version the world has ever seen. Let's study the players. 1. The central pillars: BlackRock, Vanguard, State Street. These three asset managers collectively oversee more than $20 trillion in assets. But their real power comes from majority voting control in thousands of corporations, influence over board appointments, ownership of major banks, tech companies, and energy giants, ETF domination, pension fund management. They don't just invest in companies. They influence policy, structure markets, and shape global capital flows. Cross-ownership. BlackRock owns shares in Vanguard. Vanguard owns shares in State Street. State Street owns shares in BlackRock. This triangular structure forms the core of the modern financial power network. 2. Central banks, the new command centers. The Federal Reserve, European Central Bank, Bank of England, and Bank of Japan are no longer simple guardians of money supply. They are now crisis managers, liquidity providers, market stabilizers, backstops for large banks, controllers of global financial conditions. In 2020, the Fed injected over $4 trillion to stabilize markets. But the distribution went overwhelmingly to major U.S. banks, primary dealers, Wall Street institutions, global investment firms. This reinforced the cycle. The bigger the crisis, the more central banks intervene, and the more powerful large financial entities become. 3. BIS, the global coordinator. The BIS still operates in the shadows. Its committees dictate interest rate frameworks, global banking standards, Basel regulations, capital adequacy rules, cross-border liquidity requirements, stress testing models. And because these rules are global, they shape every banking system, from Europe to Asia to the United States. The BIS creates the architecture. Central banks execute it. Large financial institutions benefit from it. 4. The rise of digital finance and crisis infrastructure. The next stage of the banking cartel involves digital money. Because digital currencies give central banks real-time control over liquidity, credit, and capital flows. The infrastructure already exists. FedNow, Digital Euro Framework, BS Project Helvetia, cross-border CBDC tests, unified digital identity proposals, real-time tax reporting models. These systems turn money into code, and code can be shaped. Digital finance isn't just faster. It is more programmable, more centralized, and far easier to control during crises. 5. The 2020 repo crisis and 2023 bank failures. These recent events reveal the pattern is still alive. 2020 repo crisis. Liquidity evaporated, Fed intervened with unlimited support, large institutions got guaranteed funding, smaller players were left vulnerable. 2023 U.S. regional bank collapse. SVB, Signature, First Republic all failed within weeks. Meanwhile, J.P. Morgan acquired First Republic, the largest bank failure since 2008. Deposits concentrated further into megabanks. Crises serve a purpose, and the purpose is consolidation. Transition to synthesis. We've traced 150 years of collapses. We've seen the institutions. We've seen the pattern. We've seen the four-stage cycle repeat again and again. Now we combine everything into a single picture. What does the next crisis look like? And why will it follow the same pattern, but faster? That's what comes next. 8. Synthesis, the pattern behind every crisis. Now that we've gone through 150 years of financial history, let's step back and look at the full picture. We have seen the rise of early banking dynasties, the creation of the Federal Reserve, the birth of the BS, the Great Depression, the S&L collapse, the 2008 crisis, the recent 2020 to 2023 failures, the emergence of digital banking infrastructure. Different decades, different governments, different triggers, but the outcomes? Identical. Crisis always strengthens the same institutions. Crisis always eliminates their competitors. Crisis always expands their influence. Let's break down why. 1. Because the system is designed for concentration. Financial regulations written after collapses always require more capital, require more liquidity, require more compliance, require more infrastructure. Small banks cannot afford these new rules. Large banks can. The result? Every regulation after the crisis pushes the system toward fewer, larger players. 2. Because crises create perfect acquisition opportunities. When a regional bank collapses, its loans are sold off cheaply, its assets are auctioned, its deposits move to the biggest banks, its market share evaporates. Large banks grow faster during recessions than in economic booms. Consolidation is not an accident. It is the outcome of the system. 3. Because central banks serve as cartel stabilizers. During every major collapse, small banks fail, large banks receive liquidity, central banks coordinate policy, governments pass emergency laws. The result? Large institutions become too big to fail, and therefore too important to regulate aggressively. This cycle creates upward concentration that no free market would ever produce on its own. 4. Because digital money is the final stage of control. In the analog era, the banking cartel needed time, legislation, cooperation, coordinated bailouts. In the coming digital era, everything happens instantly. Digital currencies allow real-time control of liquidity, instant freezing of accounts, targeted capital restrictions, programmable spending, automated compliance, centralized monitoring. The next crisis will not be managed with paper money and emergency meetings. It will be managed with code. 9. Forecast what the next crisis will look like. We cannot predict the exact spark, but we can identify the structure. Here is the most likely sequence. 1. Liquidity shock. Just like 1907, 1929, 2008, 2020. Liquidity suddenly dries up in key markets: treasuries, corporate bonds, repo markets, derivatives, foreign exchange swaps. Central banks respond with emergency interventions. But this time, the system is far more fragile. Higher global debt, higher leverage, more interconnected risks, more dependency on central liquidity. 2. Regional bank failures. Small and medium banks are the weakest links. They face deposit flight, unrealized bond losses, credit stress, liquidity pressure, capital shortfalls. Just like 2023, several will collapse in rapid succession. Who absorbs them? The megabanks. 3. Market declines plus forced mergers. During the panic, equities fall, credit markets seize, real estate freezes, pensions face losses, sovereign debt comes under pressure. Governments respond with temporary consolidation measures, just like they did with S&L, 2008, 2023. Temporary always becomes permanent. 4. Introduction of digital controls. To protect the financial system, central banks accelerate the rollout of digital identification, cash transaction limits, instant reporting, digital wallets, programmable payments, central bank digital currency, CBDC, frameworks. But these are not temporary tools. They are long-term architecture, not built for the crisis, but introduced during it. 5. The outcome, a smaller, more centralized system. At the end of the next crisis, fewer banks, more concentrated deposits, stronger megabanks, more powerful central banks, less privacy, less financial autonomy, more dependency on digital infrastructure. The system will not collapse, it will transform. And that transformation will benefit the same institutions that benefited from every crisis before. X. Final warning. Most people believe crises are faults in the system. Unfortunate accidents. Flaws that need fixing. But when you look at 150 years of history, a different truth emerges. Crises do not break the system. Crises complete the system. They are not malfunctions. They are mechanisms. Mechanisms that eliminate small institutions, consolidate power, justify new regulations, expand digital control, increase dependence on central banks, protect the interests of large financial entities. The next crisis will not be an exception. It will be the culmination of a cycle that has repeated for over a century. And when it happens, you will hear the same messages. We need more control. We need stronger oversight. We need a safer system. But the result will be the same. You will lose autonomy. They will gain power. Time is running out to understand the pattern. And once you see it, you can never unsee it. If you've made it this far, you're not like most viewers. Most people watch crises unfold without understanding the forces behind them. But you see the cycles. You see the structure. You see the pattern. If you want to stay ahead, to understand what's coming before it arrives, subscribe to Decoded Finance. Not for algorithms, not for vanity numbers, but because the world is changing fast, and knowing how money works is the only way to stay free inside a system designed to control you. This is Decoded Finance, and this was the pattern behind the banking cartel that never wastes a crisis.